This is going to be a video about a covered call trade that I was in for about a month from mid-August to mid-September of 2023. And I'm just going to go over how the trade setup went, how the trade was adjusted, and the profit and loss on this trade, just so you can kind of get a better understanding of what I was trying to do with it, how I trade. This is just one example of many trades that I do using this specific strategy. And I wanted to kind of show you how you can use covered calls to safely trade stocks that are even quite volatile, but that provide a lot of downside protection. So just a quick outline of what we're going to cover in the video. We're first going to talk about the covered call double dip intro and what this trade is really all about. What are the characteristics of this trade, why I traded, why I think it's a good strategy to use. Then we're going to jump into the specifics of this trade setup for HE specifically. Then we're going to talk about how this trade was managed throughout the month that we were in this trade. And then finally, we're going to talk about the profit of this HE double dip covered call versus just buying and holding this trade if you had just traded the stock without selling any options on it at all. Okay, so let's talk about double dip trades in general. So what do we mean by that? We're talking about selling an in-the-money covered call on a dividend paying stock. And I'll explain that in a minute, but what we're going for are two sources of income, and that's why I call it a double dip. We're capturing the call option premium and we're capturing the dividend because we're going into this stock a few days or a few weeks before it's about to go ex-dividend. So when we say in the money, what we're saying is the strike price of the call option is below the price that we bought the stock at. So if we buy 100 shares of stock XYZ at $50 a share, we're going to be selling the call option with a strike below $50. So it could be 45, it could be 48, it could even be lower than 45. But the point is the strike price is lower than the current price of the stock. And there's an important reason for that. I'll go into that in subsequent slides, but that's an important part of the strategy. But the main idea is we're selling it in the money because that gives us a lot of downside protection in case the stock goes down. And the example that I have using HE, I'm going to show you what happened in that trade and why that was very important. Okay, so let's talk about this setup for this trade and what was happening at the time. So we opened this trade on August 16th, but what happened in the days before that? So 2 days before that, on August 14th, Hawaiian Electric had a massive 40% drop in its stock price, and this was because of the Maui fires, and there were concerns that the company will be sued for liability for causing those fires. I'm going to just show you one of the articles at that time. Here's an article that talked about this. It's dated August 14th. This is literally a day before we entered the trade. And we see here that the stock sinks 37% and the wildfires are tied to the drop. And so let's see what was happening on the chart at the time. This is where the price was around $32. It then had that massive drop on August the 14th. And then August the 15th is where we actually entered this trade. So I just want to point out here, this doesn't look that good. Why would we enter this trade when this company was trading in the 30s, even here almost at $40? It has this massive drop to below $22, and then it keeps dropping below $20, and yet we still entered this trade. Well, that's what we're going to get into, but I just want to point out what the chart looked like at the time that we entered this trade. Okay, so going back to our trade setup, we bought 100 shares of HE at $16.54 per share, and that would cost us about $1,654. And at the same time, we sold an in-the-money call option expiring on the 15th of September with a $10 strike for $7.30 credit. which means we received about $730 for that. So if you take the difference between the two, we had an outlay of around $924 that we paid for this position. The next part of the setup was to capture the dividend. And in this case, the ex-dividend date was on August the 17th for 36 cents or $36 for every 100 shares. And the way the ex-dividend date works is you have to own the shares the day before the ex-dividend date. So as long as you own them on the day before, you will qualify for the dividend. In our case, we bought the shares literally the day before, so we qualified. So that was something that we would capture as well. The next thing that we wanted to kind of create as part of this trade was some downside protection. And that's what this trade gives us. It gives us a massive 40% buffer of downside protection because we got into the trade at $16.54 and our short call strike price was at $10, which means that the price could have continued moving down from $16.54 to 14 to 12 to 11 to even $10. And as long as it was above $10 at the time of our expiration or even earlier, we would qualify for, we would get a profit on that trade. And I'm going to get into kind of how the trade was managed. What we wanted to do was for the price to stay above $10, and that would still give us a 40% buffer to the downside. Okay, so let's talk about the trade management for this trade. I'm going to switch to the chart and we can follow the trade as it went along day by day. So here's the chart of the trade on the day of HE on the day that we entered. As you can see, there was that massive drop of 37% from on August 11th. Then we entered the trade on August the 15th. I'm sorry, the massive drop was August the 14th, the day before we entered the trade. We entered the trade on August 15th the next day. We entered it at 16.54. As you can see, it finished actually lower at like around 14.77. So let's follow along this trade and see what happened day by day. So here, the next day it went even lower. It went even lower. That $10 green line, that's where our short call strike is. So if you recall, we want the price to stay above the $10. It doesn't mean, even if it goes below, we still have ways to handle the trade if it breaches our short call strike, but in this case it didn't. Kind of stays between $10 and our entry price. It does drop here. This is on August the 25th. Now, we're not panicking. We're still in this trade. We're not making any adjustments at this point. We're going to continue to see what happens. Then it goes back up. So again, it just sort of stays between the $10 strike and the 16.54 entry price. And there, where it says number 2, that was the day, that was the expiration day of our strike, which was September the 15th. And as you can see, it expired above the $10 short call, which means our stock was taken away from us at $10 a share. And I'm going to go over the numbers and how everything worked out with the profit and losses. But the main idea is, even though the price finished below where we entered, because we entered at 16.54, it finished around 13.37, we were still fully profitable in this trade, and I'm going to explain that in the next few slides. Okay, so let's review the trade management for this trade. So as you saw right now when we went through the chart, there really was nothing to do in this trade after we entered on August 16th, all the way until the contract expired on September the 15th and the shares were called away from us. Now, that doesn't mean we didn't have any profit targets. What I usually do is I have 2 sets of profit targets. I have a 50% profit target and an 80% profit target, but I give them a limited amount of time to be hit. So the 50% target, I usually wait for it to be hit before half of the contract is expired, and the 80% target, I want it to be hit before 80% of the contract is expired. In this case, that didn't happen. So by the time the halfway point of the contract came, we still didn't hit the 50% target. Same thing for the 80% target. So I took those profit targets off and we just waited until the full expiration of the contract, and that's what happened on September 15th. They were just called away. The shares were just called away from us. So overall, really nothing to do in this trade as far as management. Okay, so let's review the numbers now. Let's review the profit and losses for this trade as we went along. So on August the 16th, we bought 100 shares of HE at $16.54 plus a commission. So then we had to pay $16.54 and 37 cents. At the exact same time, we sold the HE the 15th of September $10 call option, and we got $7.30 credit for that minus the commission. So we got $728.94 for that. Next, on September the 8th, we received the dividend payment. We qualified for that previously, but the actual payment is a few weeks later. So on September the 8th, we received that payment for $36. There was a 15% tax deducted. That's because this is a Canadian account in a margin Canadian account, and unfortunately they do deduct 15% at the source. So we received $30.60. And then finally, on September the 15th, the shares were called away at $10 because $10 was our short call strike. So we received $10 per share, and that would have been $1,000, but there were a couple of cents taken for commission. So we received $999.98. So again, this might not look very intuitive because we paid $16.54 per share, but we sold it at $10 a share. So that doesn't seem like it would be profitable, but it is, and I'll show you the numbers why it's profitable. The other thing I wanted to emphasize, and I know I already talked about this, was we had a massive 40% downside protection all the way from $16.54 where we entered, all the way down to $10, which was the strike of our short call option. So let's count the numbers. So if we add up all those numbers on the right side, we actually get a profit of $105.15. That was our raw profit for the trade. But we want to know, okay, what did we risk and what is the actual return or annualized return? So what we risked for this trade was actually the first two numbers, the $16.54.37 that we paid for the shares, and then the $728.94 that we received when we sold the call, because we did that at the exact same time. If you add those two numbers up, you get $925.43, and that was our risk. So we made a profit of $105.15. We risked $925.43, which comes out to 11.36% raw return. But we want to know how long did it take us to get that return. So, if it takes you to if you make 11% in a few days, that's very different than making 11% in a year. So in this case, we made 11.36% in 30 days, and that annualizes to approximately 138% a year. So as you could see, it was quite a large return in a relatively small amount of time. So what we're going to do now is we're going to compare the numbers. If you had just held the shares without selling any options on it, if you just bought the shares and held it from the same date, from August the 16th to September the 15th. So if we just bought and held the trade, so on August the 16th, we would buy the shares at $16.54 plus commission. So we would be out $1,654.37. On September the 8th, we would have received the same dividend for $36 minus the 15% tax. That would have been $30.60. And then on September the 15th, we would have sold the shares at $13.12, which would give us approximately $1,312. I'm not going to deduct commission because that's not what I did, so I'm going to kind of keep it theoretical. The main thing I want to emphasize here is that if we had just bought the trades and held them, we would have literally had zero downside protection. There was nothing protecting us. There was no safety buffer, and the shares would have gone down from $16.54 down to $13.12. This is the reason why I don't like just buying shares. This is the reason why I like trading this double dip covered call strategy, is because you get a lot of built-in downside protection. When you're just buying shares, there's literally no downside protection. The profit would have actually, well, it would have been a loss of $311.77. I'm just adding up the three numbers on the right side. The risk is actually much bigger than the previous trade, because if you remember, the risk on the last trade was less than $1,000. Here, we're actually risking the full amount that we paid for those shares, which was $1,654.37. So it's a bigger risk with no downside protection. And this, to me, is why I don't like just regular buying and holding of shares without using options. So the return would have been almost negative 19% return in 30 days. So as you could see, if you just buy shares like that drop such a significant amount, it is a pretty dangerous thing because you're very likely to lose money. But if you use the double dip strategy or this deep in the money covered call strategy that I just explained, it gives you that downside protection. So it's like a safety buffer for trades like this. Okay, so let's review a summary of this trade. One of the things I want to emphasize is price went down, but the trade was still profitable. We're not relying on the price to move up for us to be profitable. That's one of the things I really like about this type of trade. There was a lot of downside protection. So even if the price kept moving down by a really large amount, in fact, we had that 40% buffer, we still would be fully profitable in this trade. And again, just to emphasize, we're not relying on stock appreciation to be profitable. I know that's how a lot of people are used to trading, especially in the stock market. You want to buy low and you sell high. This is not that type of a trade. We're not relying on the stock to actually go up. We basically are relying on the option premium and the dividend from the stock to be our profit. I just want to wrap this up and say that if you have any questions, please ask in the comments. If you have suggestions for future videos that I can do, by all means, post them in the comments as well. I do want to make more videos like this showing different trades and how they were entered and exited and how they were managed, because there's many different variations of this trade, but I just wanted to start by showing a very basic example of how this trade works and what are the advantages of it and why I like to trade it. Thanks a lot, guys.